Everyone is after the end goal. They want the keys to an Italian supercar, the kind that vibrates with pure status. They want the mansion with floor-to-ceiling glass, where the view is just as clear as the fact that you have finally arrived. But the market is indifferent to your dreams. It certainly does not care about your car payments. There is a reason 90% of traders lose 90% of their capital within their first 90 days. Do you know why? It's not because they had a bad strategy. It's because they tried to build the roof of a house before they poured the concrete foundation. Before you ever analyze a candle, rely on an indicator, or click the buy button, understand this first. The market does not exist to make you rich. Its purpose is to transfer risk from those who want to reduce it to those willing to take it. If you want to trade Forex, stocks, options, or commodities, there is a correct order you must follow. Most traders fail because they start in the middle, jumping straight to strategies, indicators, or signals without understanding the foundation that supports everything else. In this video, I will give you a precise, step-by-step roadmap for learning how to trade the right way. You will learn the correct learning sequence, what a trading vehicle is, what instruments are, what brokers actually do, and the 4 critical things you must understand before placing your first trade. This is not theory. This is structure. Follow it, and you're not gambling. You're building a trading business. Step 1. Pick your vehicle. Before you learn strategies or timing, you must choose your trading vehicle. A trading vehicle is the market environment you operate in, the terrain you're driving on. Each vehicle behaves differently, carries different risks, and rewards different skill sets. Forex is like a 24-hour highway. It runs almost non-stop 5 days a week. Liquidity is deep, movement is constant, and currencies respond primarily to interest rates, economic data, and central bank decisions. It's smooth when conditions are stable, but dangerous when volatility spikes. Stocks are like a downtown business district. They have strict opening and closing hours, rules, and regulations. Prices are driven by company performance, earnings, leadership, and investor sentiment. Orderly most of the time, but gaps, news, and earnings can cause sudden traffic jams or crashes. Commodities, like gold, oil, or wheat, are the wilderness. They respond violently to supply and demand shocks, wars, weather, geopolitical tension, and scarcity. These markets don't care about opinions, only reality. When disruption hits, price moves fast and unforgiving. Options are like engineering blueprints, not roads. They are derivatives, meaning their value comes from something else, stocks, indices, or commodities. Options allow you to control risk, time, and probability. You can profit from direction, speed, or even stagnation, but misuse them, and time itself works against you. Beyond these, there are other derivative vehicles. Futures, contracts that lock in prices for delivery later, used heavily by institutions and producers. CFDs, or contracts for differences, synthetic instruments that mirror price movement without owning the asset. Swaps and forwards, primarily institutional tools used to manage long-term risk. Each vehicle has different volatility, different leverage, different risk exposure, different learning curve. There is no best vehicle, only the one that matches your capital, time, psychology, and risk tolerance. Choose the wrong terrain, and even a good driver crashes. Choose the right one, and every step after this becomes clearer.
Step 2. Choose your instrument.
Once you've chosen your vehicle, the next step is selecting your instrument. An instrument is the specific asset you are trading inside that market. If the stock market is the city, Apple is the car you're driving. If Forex is the highway, Euro/USD is also the car you stay in. Professionals do not play the market, they specialize. They trade a small number of instruments and study them deeply. They know how each one behaves under pressure. They understand how Euro/USD responds to interest rate announcements, how NASDAQ reacts to earnings season, or how gold behaves late on a Friday when liquidity thins. Every instrument has a personality. Some trend cleanly, some chop sideways, some respect technical levels, others ignore them and move on fundamentals. Jumping between 50 charts doesn't make you diversified, it makes you unfocused. Mastery comes from repetition, observation, and familiarity. Pick one or two instruments. Watch how they move during different sessions. See how they react to news, volume changes, and time of day. When you know an instrument well, you stop guessing. You start anticipating. This is how randomness turns into probability. Step 3. Choose your broker carefully. You cannot walk onto the floor of the New York Stock Exchange and hand someone $100. You need a broker. Because the general public is no longer permitted physical access to the trading floor, and all transactions must be conducted through authorized, regulated intermediaries called brokers. One of the reasons being the transaction process. The systems used for trading are complex and designed to handle massive volumes of shares with high efficiency in auditing. A simple cash transaction would be incompatible with these modern regulated systems. But understand this clearly. Your broker is either your strongest partner or your biggest liability. A bad broker doesn't have to scam you outright. They slowly drain you through hidden fees, wide spreads, poor execution, and platform failures. Costs most beginners never notice, but always pay. Before trusting any broker, ask 3 non-negotiable questions. Are they regulated? Regulation is your legal protection. No oversight means no accountability. Are the fees transparent? If you don't understand how they make money, you are the product. Is the platform stable and reliable? Crashes during volatility aren't accidents, they're fatal to your edge. And one final rule. If you haven't tested a broker on a demo account for at least 1 month, do not fund it with real money. Never trade with money you can't afford to lose, especially rent money. A professional trader treats broker selection like choosing a business partner, not downloading an app. Step 4. Learn to read the map. Once you've chosen your vehicle, your instrument, and your broker, you must learn to read the map. Price does not move because of lines, indicators, or drawings on a screen. It moves because of human behavior, fear, optimism, urgency, and uncertainty expressed through price. There are 3 core elements you must understand. Market structure. This tells you directional intent. Higher highs and higher lows signal optimism and acceptance of higher prices. Lower lows and lower highs signal fear and rejection. Structure reveals who is in control, buyers or sellers. Liquidity. This is the fuel in the tank. Liquidity determines whether you can enter and exit efficiently. Low liquidity traps traders in bad positions. High liquidity allows smooth execution with minimal friction. Volatility. This is the speed of the market. Too little volatility and price goes nowhere. Too much and risk becomes unmanageable. You're not looking for chaos, you're looking for controlled movement. At this stage, you are not predicting the future, you are interpreting the current environment. Your goal is not certainty, it is probability. You read the map to identify a high probability path, then manage risk as the market reveals itself. This is where trading stops being guessing and starts becoming decision-making. Step 5. Risk management, the real edge. This is the step most people skip, and it's exactly why accounts get blown. Trading is not about how much money you can make. It's about how much you are willing and able to lose. Amateurs enter a trade asking, "How much can I make?" Professionals enter asking, "How much am I willing to pay to find out if I'm right?" That difference is everything. Risk management is the system that keeps you in the game long enough for probability to work. Without it, even a good strategy eventually fails. If you risk 50% of your account on a single trade, you are not trading. You are gambling. And in gambling, the house always wins over time. Professionals define risk before they enter. Position size is calculated, not guessed. Loss is capped and accepted. Survival is prioritized over profit. You don't need to win every trade. You need to avoid catastrophic loss. Because in markets, consistency doesn't come from big wins. It comes from controlled losses. Master risk management, and everything else finally has room to work.
Step 6. Build the strategy, then master yourself. Only now, after you understand the market, your broker, and your risk, do you build a strategy. A strategy is not magic. It is simply a set of conditional rules. If price reaches a specific level and volume confirms participation, then I execute. That's it. But here's the truth most people ignore. A strategy without discipline is worthless. Your biggest enemy is not the market, it's the person staring back at you in the mirror. Revenge trading, greed, fear, impatience. These emotions don't break strategies, the trader does. Master your mind or it will sabotage even the best plan you have. A professional doesn't trade emotions, they execute rules. Finally, the 4 laws. Before you go, remember these 4 laws. The big picture rules. The weekly trend always overpowers the 5-minute trend. Trade with structure, not noise. News is the spark. You don't need to trade the news, but you must always be aware of it. Mindset is everything. A bad mood is a bad time to trade. Emotional instability leads to financial mistakes. Practice is mandatory. If you can't follow rules and manage risk on a demo account, you will not succeed on a live one. Trading is a marathon, not a sprint. Follow the order, respect the process, and over time, the market will pay you for patience, not excitement. Welcome to the mindset. I will be seeing you in the next video.